Real estate vs stocks, the real math, which one will make you more money? Imagine two friends starting their wealth-building journey on the same day. One buys a house, the other buys stocks. 30 years later, both are millionaires. But here's the strange part. One invested far less money, one took far less risk, one spent far less time worrying, and yet they both ended up wealthy. So which investment actually won for decades? People have argued about real estate versus stocks as if there must be one clear winner. Some swear that property is the safest path to wealth. Others believe the stock market is the greatest wealth-building machine ever created. But the truth is more complicated, because the answer isn't just about returns, it's about time, it's about behavior, it's about freedom. And most importantly, it's about understanding the math most people never calculate. By the end of this video, you'll see why the investment that makes the most money on paper is not always the investment that creates the most wealth in real life. Let's start with a story. In the early years of his career, a successful business owner became obsessed with real estate. Every extra dollar went into properties, houses, apartments, rental units. Years later, his net worth looked impressive. On paper, he was wealthy. But there was a problem. Every property came with maintenance issues, repairs, tenant problems, taxes, paperwork, and endless decisions. His wealth kept growing, but his freedom kept shrinking. Meanwhile, one of his friends quietly invested in stock index funds every month. No tenants, no repairs, no midnight phone calls, just automatic investing. After several decades, both ended up financially successful, but one spent far less energy getting there. Now that's where things get interesting. Most people compare real estate and stocks by asking a simple question, which grows faster? But that's only part of the story. Let's look at the numbers. Historically, broad stock markets have returned roughly around 10% annually before inflation over long periods. Real estate appreciation has often averaged much lower, frequently around 3 to 5% annually, depending on location and time period. At first glance, stocks seem like the obvious winner. Case closed, except it isn't. Because real estate has a secret weapon, leverage. Imagine you buy a $300,000 house with a $60,000 down payment. If the property rises 10% in value, you've gained $30,000. You didn't invest $300,000, you invested $60,000. That means your gain relative to your own money is much larger. This is why many real estate investors become wealthy. They use borrowed money to control large assets. When things go well, leverage can multiply returns. But what many people forget is that leverage works both ways. During housing crashes, some homeowners discovered that their properties were worth less than the loans attached to them. Their wealth didn't simply decline, it disappeared. The same tool that accelerated gains accelerated losses. The real lesson isn't that leverage is good or bad. The lesson is that leverage amplifies outcomes, and outcomes depend heavily on timing, discipline, and luck. Consider what happened during the global financial crisis of 2008. Many believed real estate prices could only go up. People borrowed aggressively. Some bought multiple properties. Then the market turned. Home values collapsed in many places. Families lost homes. Investors went bankrupt. Years of wealth vanished. But here's the surprising twist. The stock market also crashed. Investors watched portfolios fall dramatically. Fear spread everywhere. Yet many of the people who became wealthy afterward were not the ones who predicted the crash. They were the ones who stayed invested. They continued buying while prices were low, and over time the market recovered. What happened next changed everything. The biggest advantage of stocks may not be higher returns. It may be simplicity. Every month, millions of people automatically invest through retirement accounts and index funds. They don't negotiate purchases. They don't inspect roofs. They don't search for tenants. They simply keep investing. And compounding does the heavy lifting. Compounding is one of the most powerful forces in wealth creation. A dollar invested today earns returns. Then those returns earn returns. Then those returns earn even more returns. The process starts slowly, almost disappointingly slowly. Then suddenly it accelerates. Many fortunes were not built through brilliance. They were built through patience. And that's a lesson both stocks and real estate share. Neither rewards impatience, both reward time. But there's another factor people rarely discuss, liquidity. Imagine an emergency happens tomorrow. You need money quickly. Selling a stock can often take seconds. Selling a property can take months. This difference matters more than people realize. Financial stress is not just about how much wealth you have. It's about how easily you can access it. A person worth $1 million on paper can still feel trapped if all their money is locked inside properties. Another person with a smaller net worth may feel more secure because they have flexibility. And money is ultimately about choices. The ability to say yes, the ability to say no, the ability to spend time where it matters most, but there is one final piece of the puzzle: human behavior. Because investments don't fail people nearly as often as people fail investments. Some investors panic during market crashes and sell stocks at the worst possible time. Others buy properties they don't understand because everyone else seems to be getting rich. The problem isn't the asset. The problem is often emotion: fear, greed, impatience. The famous investor Warren Buffett once said that investing success is not mainly about intelligence. It's about temperament, and history repeatedly proves him right. The person who steadily invests in stocks for 30 years often beats the person who constantly jumps between investments searching for the next big opportunity. The landlord who carefully manages a few good properties often outperforms the investor chasing quick real estate profits. Success rarely comes from complexity. It usually comes from consistency. So which one will make you more money? The honest answer is that either can, and sometimes both together create the strongest combination. Real estate can provide leverage, rental income, and tangible assets. Stocks can provide diversification, simplicity, liquidity, and powerful compounding. But the real math isn't just about percentages, it's about behavior over decades. Because the greatest investment isn't the one with the highest return on a spreadsheet. It's the one you can stick with through fear, uncertainty, boredom, and time. That's the investment most people underestimate, and perhaps that's the biggest lesson of all. We often think wealth comes from finding the perfect opportunity, but wealth usually comes from staying committed to a good opportunity long enough for time to work its magic. In the end, money is not really about houses or stocks, it's about freedom. Freedom to spend time with family, freedom to choose meaningful work, freedom to live life on your own terms. The people who understand this stop chasing the perfect investment. Instead, they focus on building a system they can follow for decades, because the investment that changes your life isn't always the one that grows the fastest. It's the one that helps you stay in the game the longest. If you enjoyed this video, make sure to like, subscribe, and leave a comment sharing the lesson that impacted you most. And remember, the richest asset you'll ever own isn't real estate or stocks. It's time. Everything else is simply what you do with it.